We are having a very busy week in the market. We can see quite a number of large companies that are reporting or in fact have reported so far, and we can see that within the map of the S&P there is a lot of companies that are down significantly, like PayPal 11%, ServiceNow 10%, but there are also companies that have performed very strong, notably Palantir up around 27%. Now today we want to look at three quality companies that are down on the earnings dip. The first one is Qualcomm, in fact down nearly 6% in the pre-market. They have released their earnings not too long ago, and with each company we're going to run through how they've performed, understand where the drop is coming from, and also get to our own valuation to understand how undervalued it is and what is the upside Wall Street does expect. Now the first company, as we said, the semiconductor giant Qualcomm, they actually topped their estimates for both earnings as well as revenue, and in fact also have strong demand for their smartphone. So when we take a look at the EPS, looking very impressive in fact, $3.41, well above the $2.96 the market had forecasted, and the same to be said on their revenue, so I would take that as a very big win. 11.67 above the 10.93, that is a double beat. We can also see for the quarter that means that their revenue is up 18% in comparison to the same quarter year on year. And we can also see their guidance is very strong, actually higher than the midpoint of what the market wants to see. 10.2 to 11, market is expecting 10.34, and the same to be said for the EPS, 2.7 to 2.9, above the 2.69 of market expectation. Bottom line also as impressive as their top line, which is up 15% from the same quarter last year. And when we take a look at some of the specifics in terms of the divisions in their revenue streams, we can see the most important market for Qualcomm is the mobile handsets, and they are up 13% on an annual basis. That is very positive given the fact the market was anticipating only 5%. We can also see the fastest growing market for Qualcomm, the automotive business, which is up 61% to 961 million. They also expect their handset revenue to continue the very strong growth to around 10% for the full year. And there was a mention of DeepSeek, the R1 AI model that did cause the overall semiconductor market into a bit of chaos just last week, where they've come out and said that the model is actually good for Qualcomm because its chips can run the efficient model locally instead of in the cloud. So going back to the company, they are down more than 5% in the pre-market. Over the last year, they are still up around 22%. Over the last 10 years, they're up around 144, not far off the S&P during the period, and currently when the market does open, they will be trading right there towards their 52-week low. We also get a double buy from both Seeking Alpha and Wall Street, and we can mention they do pay a current dividend which is just below the 2% mark. If we were to take a look now at their earnings expectations, out of the next 4 quarters, they're expecting the first 2 to be double-digit growth, with growth in Q4 and a small drop in Q1 of 2026. Having said that, over the last 4 quarters, they have outperformed analyst targets, and by quite some way, which is very impressive. In terms of September 2026, this EPS, if it does get hit, will lower the forward P to 14.5. Now if we take a look, that is significantly lower than the sector median. In fact, you're getting around a 40% discount, and it is also trading now at a discount to their 5-year average, which is typically an undervaluation signal. If we were to take a look at their growth rate, they get a D. Now bear in mind, their year-on-year revenue growth of 9% is above the sector of 5, however does come below their 5-year average, and the same to be said for their projections over the next 12 months. If we take a look though, one area that they do lack, and the reason why they get a D on the rating, is the earnings per share expected over the next 3 to 5 years to grow at 5.3%, which is quite some way below both two comparatives of 15 and 16% respectively. Then we can also show you where they come out on top with the profitability at an A+. We see gross margin 56 above the sector of 50, only very marginally lower than their 5-year average, and the bottom line actually comes out on top, 26 above both 4 and 24%. We also do quite like the fact this company continues to generate a significant amount of cash from operations, 12.2 billion above the 101 million and 9.61 billion of both sector and their historical numbers. We can also show you, based on dividend yield theory and the forward PE, given they aren't too far off, we would typically call this a reasonable valuation signal. And we can also see their dividend safety score does come in right now at 80, with their latest dividend increase at 6.3% in March last year. So next month we will be eagerly anticipating seeing the rate of what the dividend increase for Qualcomm will be. In terms of institutional ownership, around 74%, we do see just under 10 billion worth of sales over the last year. However, we get around 70% worth more of buys at 16.52 billion. So we do notice, at least in 2024, institutions as a whole were very bullish on Qualcomm. Now, diving into our valuation, our intrinsic value today is $208. Now, whilst we do typically run through each model where we look at the inputs and outputs, today getting straight to it, as we are covering two other companies, we don't just stop there, as we do apply a margin of safety, kicking off at 10%, executing on that if it meets our three golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, in today's episode, a buy at $187, but we keep going till it's near the current trading price, and pretty much around the $167 mark, not far off where this company sits, you are getting a 20% MOS, with Wall Street and their buy rating believing this to hit $200 by the end of 2025, translating to 19% upside. As always though, give us your own thoughts if you think these are a buy, hold, or sell, and you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Qualcomm or any others. Now, we also want to let you know we have released our latest free weekly article. We cover severely undervalued stocks for your attention, as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 45 undervalued stocks for the month of February. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can also grab a copy of 43 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to Uber, which when they announced their earnings, we can see in the trading day were down around 8%. They have started to recover, although only a little bit at 1.2 in the pre-market. And we do notice Quant give this company a strong buy. Wall Street give this a buy, but 4.47, not far off the 4.5 to flip this into another strong buy. And Seeking Alpha also with the buy rating. Currently trading at the lower end of the 52-week range, this company, unlike Qualcomm, does not pay a dividend, and over the last 5 years, they are up around 75%. If we take a look at their earnings, headline tells us they did beat on their fourth quarter revenue. However, probably likely the main reason for the drop was that they did lower their guidance, or it was a lot softer, which ultimately means the market did want to see this a lot higher. So diving into the numbers, the earnings per share we do in fact notice was 23 cents, actually below the 50 cents the market wanted to see, so probably one area that did in fact disappoint. Revenue did look pretty good, just under 12 billion, above the 11.77 of expectations, and their revenue was up 20% in Q4 from the same quarter last year. That is very strong, something we do expect though from the company. And the bottom line also up. They reported around 6.9 billion, which is a massive increase from the 1.4 billion reported in 2024. We also noticed their gross bookings of 44.2 billion was very strong when you do compare it to analyst expectations, 43.49. And in terms of the next quarter, the expectation on the gross bookings, they see it around 42 to 43.5 billion. However, analysts wanted to see at the higher end at 43.51, and the EBITDA expectations of 1.79 to 1.89 is, as we can see, on the lower end in terms of the midpoint of the 1.85 of analyst expectations. Again, remember, analysts, they will punish even if we believe it to be a very trivial difference. And the CEO does mention here their performance has been powered by rapid innovation and execution across multiple priorities, including the massive opportunity presented by autonomous vehicles. And we also want to show you their largest business segments were up very strongly, 18% on the mobility growth, and a very similar increase on the delivery as well. So overall, it did look like a very strong quarter. However, they were ultimately punished due to the fact the guidance wasn't what the market wanted to see. And when we do take a look at their earnings per share estimate for 2025, it is currently trading on a valuation of around 26.04, which when we do compare it against the sector of 20 is trading at a bit of a premium. Is it worth the premium? Well, you could say yes, given the growth is at an A. Both year on year 18% and revenue of 16% over the next 12 months is above both sector on those two accounts. However, they do come under both accounts, both historical and moving forwards, lower than the 5-year average of the company. But one thing we do quite like is the EPS expected to grow just over 41% year on year, significantly higher than 11.54 of the comparative sector. Also, profitability looking good, A+. Gross margin 33% above the sector, pretty much in line with their 5-year average. Bottom line 22.4%, well above the sector comparison, and over the last 5 years this company was in fact losing money, hence why we get the negative 23%. And the cash from operations very strong, over 7 billion, completely wiping out those two comparatives. So overall, it did look very strong. We also want to highlight here that the institutions with 80% ownership have been selling around 10 billion over the last year, but they bought a significant amount more, around 80% during the same period, 17.4 billion. And we also want to flag in Q4, they've been buying a lot more. So just also in the last few weeks and the last few months, institutions continue to buy a lot. Actually, a theme we have seen right across 2024. Now, in terms of the valuation, we have increased it or revised it upwards after the earnings to $104. We now have their full year 2024 free cash flow, which was a massive 105% jump. Now, moving forwards, we have gone for 10%. As you can see, a low, medium, and high. Again, you can grab a copy of this model by clicking below, running through whether it's your own numbers here or another company. But with a discount rate, we get the present value of future free cash flows and terminal value, where we add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as you can see, indicating 60% upside. Now, for those that believe that is too high, at 8%, $90, again, very large upside. And for those that are a lot more bullish or uber bullish, in fact, at the 12%, $120, that is 85%. Now, we'll take the 10%, which actually we have lowered from our previous valuations, and that also tells us there is going to be a very healthy margin of safety. As we keep going in today's episode for Uber, you will notice not at the 40% level just yet, but up to around $68, you're getting at least 35%. Wall Street themselves revising their price target. They see this near $100 by the end of 2025. That is a 51% increase. And again, do let us know your thoughts, whether you actually like the earnings, whether you're buying, holding, or in fact selling. We then move on to the Walt Disney Company, which after reporting their earnings is down between 2 to 3%. Over the last year, they are up around 14%. Over the last 10 years, they're up only 9%. We can see all-time highs now. We are talking around 4 years ago at the $200 mark, trading when the market opens around the midpoint of the 52-week range, with a double buy from seeking out from Wall Street and with a yield that isn't far off the 1%. If we take a look at their earnings headlines, it says they top their quarterly profit estimates. However, they have started to lose Disney Plus subscribers. So if we take our way into the numbers, well, we can see earnings per share for the company at 176, quite a healthy beat from the 145 anticipated, and the revenue just under 25 billion, again just a marginal beat from the 24.62 expectations. But their bottom line is up nearly 23%, very impressive to see, and the revenue for the quarter is up around 4.8%. We can see though something we mentioned above, that the total Disney Plus subscriptions stand at 124.6 million, which is actually lower than the 125.3 at the end of Q4. Now, they do pinpoint this slowdown to streaming subscribers down to the increase in prices, which does make sense. It's also telling them the consumers aren't going to be accepting continual increases in subscriptions, but it isn't just Disney Plus. We've seen this with the likes of Netflix, YouTube TV as well. So it will be interesting to see how far these competitors can go before we see something similar with subscriptions decreasing. When we take a look at other information as well, we can in fact note that the entertainment division is up around 9%, which is very positive to see, and that the Disney box office success really helped this company in terms of the numbers. We can see here the debut of Moana 2 over Thanksgiving did help them push the box office to new heights, and it topped around $1 billion during the Martin Luther King Jr. Day weekend. There were also some other very positive news here at the end of 2024. Deadpool, Wolverine, Inside Out 2, Moana 2, as well as The Lion King. In terms of earnings then, it is good to see their 100% track record over the last 4 quarters, but we do still anticipate a bumpy ride over the next 4, with only 2 of them positive. And if we look to September 2026, the forward PE does estimate to sit around 18.2. If we look at the valuation, they get a D, which does tell us they are trading at a premium to the sector of 14.33, around 42%, but actually they're trading a lot lower than their 5-year average of 42, around 52%. If we take a look at their growth, a D+. Now we do notice, only marginally though, their year-on-year revenue and forward expectations are above the sector comparatives. However, over the last 5 years, we have seen their revenue numbers a lot higher, which does tell us there has been a little bit of a slowdown. We also notice that in the EPS over the next 3 to 5 years, whilst marginally above the comparative, is some way away from the 21% we have seen on a historical basis. Profitability looks good at an A+. Gross margin, it is significantly lower than the sector comparative, although above their 5-year historical rates, but we do in fact note their bottom line has improved significantly above both of these comparables, and the cash this company generates from operations not only significantly above the sector, but we're talking double from what they are used to based on the last 5 years. If we were to look at this company, well, we can in fact see, in comparison to their own historical average, this company does trade at a cheaper valuation. That indicates to us possible undervaluation. And we can in fact see a 70 on the dividend safety, with an 11% increase to the dividend in December last year. If we look at the institutions, 66% ownership, around 12 billion worth of sales, but we do get a bit more worth of buying in 2024. So as a whole, institutions do like Disney. And when we run it through our own valuation, our price of $129 does give at least a margin of safety of 10% at 116. At 15%, pretty much at the $109, $110. With Wall Street themselves, they see $128 by the end of 2025. That is 16% upside. And bear in mind, a lot of analysts, as we have seen over the last few weeks, believe the gain in the S&P for 2025 will be around the 10% point, so you could look at this as something to outperform the S&P at least in the shorter term, but again, do give us your thoughts in the comments below. Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. We have been buying and selling in this volatile period, and have a great day. We'll see you all on the next one.